Ahoy there, trader, and welcome back. This is the Anti-Investor Swing Trading Podcast. So let's talk about the real risk and a better way to look at what your number is. Now, there's a movie I like with a Lee Marvin and a young Clint Eastwood. And have you ever, by any chance, heard the wonderful musical known as Paint Your Wagons? It's about the gold rush era in California circa, well, a long time ago. Now, there's so many favourite scenes in this movie, but one of the relevant ones to today's retelling is when Marvin's character is slightly hungover and possibly even still blind, rotten drunk, and he stumbles into an auction and discovers something that is very highly desirable on the auction block. Now, then shouting as loud as he can because he wants it, whatever the price is, I'll double it, and then quite literally falls over and passes out. Now, despite being despite it being a big number, it was a number that he was happy with. It was his number, and everyone has a number in mind, one that they're happy with to risk as their essentially individual trade risk. But what is your number? So, all joking apart, do you have a sensible per trade risk number rather than just double it and risk it all and take your chances? Do you have something that's sensible in mind that helps you avoid the risk of ruin? So welcome to the Anti-Investor Swing Trading Podcast, where we talk about swing trading stocks, stock options and index futures, and maybe the occasional day trade or three. My goal is to give you the right tools, the correct rules, some software to assist you, a community to support you, and if you'll allow me to be a mentor to show you the right way so that you get real results in the fastest and smartest possible way. Now today, if you're not already gathered, I'm talking about risk, specifically the per trade variety. Now, practically, the textbooks and so-called experts suggest a percentage of capital, which conservatively even, is usually 1 to 2% and potentially up to 6%. It depends on a few factors, but usually it's a single-digit percentage of your available capital to risk per trade. Now, personally, I'm an advocate of small is better. I want to trade frequently with multiple positions, so my individual trade risk is typically sub 1% and usually around 0.5%. And obviously, if you're trading less frequently, then that percentage can obviously increase slightly. Now, the reality, though, is often quite different for newer traders. The reality is that we also have to consider other things than our practical ability to trade, the percentage of your available funds. You have to consider your mental bank balance, or the emotional bank balance is how I sometimes have phrased it. And this is a figure that we all have floating around inside our noggin. That figure is your mental bank balance, and it's a real dollar risk figure. And this is the one that allows you to sleep at night. Again, it's got nothing to do with practicalities, but it is the one that is going to hold you back or accelerate you forward as a trader. And what I mean by that is maybe 2% of your account or 1% of your account or even 0.5% of your available funds. It's just too much. Most people have a smaller mental bank balance than they have as a practical bank balance. And you'll know what I mean when you've gone to place a trade or 2 or 3 or 4, 10 trades deep. You may be on a little bit of a negative run where things aren't quite going your way. And because of the per trade risk that you've allocated to your trading, it can stop you from placing the next trade on the one after and the one after that. You have this, or a lot of novice traders have the desire to win it back or to win big or push all their chips into the table. And even if you are trying to apply sensible money management, maybe your per trade risk is just not there yet. You're okay with the first trade, maybe you win small, maybe the second trade you win small, and then the stop losses hit on the third one. And it just prevents you from placing that next trade. You have all these self-doubts and fears come into play. And because the per trade risk is, emotionally too much, but practically is fine, you can afford it, then it just stops you from placing the trade. And inevitably, that's the one that's going to go to target or be the 10-bagger or to the moon or whatever the thing is. It's always going to be the one that would be the bigger of the trades compared to the last several. And it's just, Murphy's Law, essentially. So what we want to do is we always want to have a figure that is sensible, that is practical, that is within your emotional capabilities. So you can think of it like, let's just think of it in blocks of 10 or 20 trades, blocks of 10 trades. If you had 10 monetary losses, again, not losing trades. Again, I also want to, just a little sidebar here, just draw a distinction between a losing trade and a monetary loss. A losing trade for me is something or a trade that is off plan. If you have got a robust trading plan that's time tested, proven, and has a positive expectancy, meaning on average it wins, then if you're let's just say that you expect to, 6 out of 10 trades, on average. I appreciate you can have, over large sample sets, it does vary, but that's a conversation for a different day. But let's just say, you're expecting 6 out of 10 trades to make money, 4 out of 10 trades on average over a long period of time to, lose some money. If you lose some money, then that's part of following the plan. You're expecting some losses. So let's redefine what we call a losing trade. A losing trade is one where you don't follow the plan. You've not got an edge at that point that's time-tested, proven, that you can have your faith in. So if we redefine what we call a losing trade, then the losses that you incur as a part of your strategy or following it to the letter are expenses. You're expecting to have them. They are inevitable. So for me, it's a monetary loss if it's an on-plan trade that is just one of the ones that didn't work out based on our expectations for the strategy. So now that we've got that losing trade out of our system, let's think about monetary losses. What is your, again, let's come back to the what I was originally going to talk about, which is if you have 10 trades that lost, 10 trades on the trot, again, it's going to happen at some point. I've certainly had it. We don't want it. It's emotionally devastating, but we want to have our per trade risk down to the point where you can put the 11th trade on. And I appreciate, it's just an example just to illustrate the point, because you can equally see 10 back-to-back winners. So we want to be able to place the trade, and not get overexcited and have the opposite experience, the euphoric experience where, everything you touch is golden. We want to be able to cater for the worst case scenario. So if you plan for the worst, you'll always be in for the best of those opportunities that you're trading. So I want to be able to both physically, practically, and emotionally be able to place the next trade and the next trade and the next trade, because all strategies are going to have drawdown phases where the 6 out of 10 trades are winners. You're going to have those times where 6 out of 10 trades are losers. It's just a statistical inevitability when you've got a time-tested, robust, proven strategy with a positive extension. You're going to have series of trades that just not quite performing the way that we expect them. So we need to be able to account for that worst case scenario, so that when the good times come, I'm nicely positioned in a good state of mind, so that I'm not going to miss the damn move. And that's the whole point of having your number. So how do we apply this in the real world? Trade small. Find your tolerance number. The number is where you're not losing sleep at night, you're not wondering what the markets are going, you're not sweaty palms, you're not hesitating over placing the trade. And what trade size that you could lose 5 or 10 times in a row and not be preventing you from placing the next trade. It's still going to be frustrating, but you should be able to place the next trade. And obviously we want a trading plan, consistent application of a positive expectancy strategy, and that wins the race in the long term. So trade small, trade with sensible risk, trade with a plan. If you need some help with that, shoot me a message. I'll always point you off in the right direction if what I do isn't right for you. But if you like the sound of what I do, whether it's day trading, swing trading, stocks and options, index futures, whatever you're looking for, we can certainly have a longer conversation about that. So with that said, I think that's all we've got time for this week. And if you like what you heard today, be sure to follow and listen to the very first episode where I map out one of my most profitable money-making patterns. So have a wonderful day, and I'll speak to you at the same time next time. Toodaloo Trader. Keep in mind that futures, options on futures, stocks and stock option trading involves a degree of risk that may not be suitable for all investors. Past performance is no guarantee of future performance. Anti-Investor provides educational information and does not provide financial advice.